Individuals with high net worth rarely pay for large expenses out of their checking accounts or by selling their portfolios. Instead, they use a strategy known in wealth management as buy, borrow, die, leveraging their holdings to secure a securities-based line of credit, or S-block. An S-block allows an investor to borrow cash against the value of their stocks or bonds. Because they are borrowing rather than selling, the underlying assets remain invested to capture long-term growth, and the transaction generates no realized capital gains. The collateral secures the loan, and the borrower gains immediate liquidity. This diagram compares traditional S-block against a Web3 alternative. Left, a stock portfolio is pledged for bank fiat credit. Right, vaulted physical gold maps to a smart contract. This model zeroes out external fiat liabilities instantly, while the gold collateral remains securely locked and untouched. Executing this requires a specific fiduciary structure. It relies on a Lex node operator, a specialized administrative entity operating a private sovereign treasury system. The operator bridges the physical reality of the vaulted gold to the digital execution of the blockchain. To understand how this functions, we will trace the exact legal and cryptographic workflow of the digital conveyor belt, starting with a passive physical asset in a vault and ending with an automated, decentralized debt settlement. Relying on a traditional bank for an SBLOC requires submitting to external interest rates, underwriting algorithms, and the possibility of a margin call if the broader market drops. By moving the collateral base to vaulted gold and the execution to a Lex node operator, the individual removes fiat authorities from the equation and assumes total control over the lending parameters. The process begins in the physical world. The collateral, in this case physical gold, sits passively in a secure vault. It holds value, but in its raw physical state, it cannot interact with a smart contract or be instantly leveraged to pay a debt. Before any token can be minted, the Lex node operator must establish an irrefutable, machine-readable legal standing for that exact physical asset. Code cannot execute properly if the underlying property rights are ambiguous. The operator utilizes a structural interface known as the gold-back box. This acts as the legal container, attesting to the precise amount, location, and ownership of the physical custody, serving as the bridge to the digital ledger. The operator must then formalize the client's security agreement and promissory note. A commissioned civil law notary conducts a formal jurat ceremony over the documents, establishing the living intent of the parties and finalizing the agreement as the enforceable law between them. This diagram illustrates the next step. The notary applies a cryptographic seal to the finalized security agreement. That cryptographic seal automatically translates the physical document into a machine-readable JSON code block. This log contains the exact time, date, and hash, creating an immutable, court-admissible record of the notarial act. Simultaneously, the operator files a UCC1 financing statement, typically in Delaware, to publicly record the security interest. The JSON record on the blockchain points directly to this state registry filing. The combination of the immutable notary chain hash and the active UCC1 filing satisfies the strict requirements of traditional commercial law. The asset is publicly claimed and cryptographically verified. This specific structure complies with Uniform Commercial Code Article 12, which dictates that establishing verified digital control over an asset is legally equivalent to having physical possession of it. The asset's chain of title now exists in two synchronized states. It is legally enforceable in a traditional courtroom, and it is entirely machine-readable, ready to be recognized by an automated smart contract. Tokenizing real-world assets often fails because the digital token has no binding connection to the physical item. By forcing the asset through a notarized jurat ceremony, a UCC1 filing, and a cryptographic hash, the operator ensures the token is anchored by actual, enforceable property rights. Legal perfection proves who owns the asset, but risk management dictates how that asset can be handled. Before any value is allowed to move, the system requires strict structural boundaries. This diagram outlines the four-account system, which divides assets into four distinctly segregated vaults: personal, business, trust, and other. This architecture is necessary to prevent the illegal commingling of funds. Maintaining legal protection requires strict fiduciary isolation. The system enforces a hard area between the trust vault, which holds the collateral, and the personal vault, ensuring every internal transfer is documented and deliberate. The entire architecture remains dormant until a specific condition is met. The system utilizes a quantitative mechanism called the fiduciary trigger. When the account reaches an aggregate balance threshold of $2,500, the fiduciary trigger fires, activating the automated compliance sequences and bringing the system online. Crossing this threshold reclassifies the account. The system moves from a state of passive holding into an active tokenization-ready status, allowing the operator to initiate execution commands. The first automated sequence upon activation binds the newly active trust account to a $100 million master insurance policy issued by an institutional provider like Lloyd's of London. This institutional backstop provides the risk mitigation layer required to satisfy the baseline underwriting and lending protocols necessary for the asset to function as valid collateral. By coding the $2,500 threshold and the insurance binding directly into the smart contract, the system replaces human compliance officers with algorithmic triggers. The integrity of the trust is maintained by immutable code. With the legal standing verified, the account segregated, and the insurance bound, the system is finally clear to execute the digital minting process. The smart contract generates a digital twin of the physical gold agreement, known as an ERC-721 claim NFT. This token represents the verified legal rights to the underlying asset. This diagram demonstrates how that asset is formatted. The token is wrapped in a compliance shield built on the ERC-3643 standard, a specific protocol engineered for highly regulated securities and compliance tokens. The ERC-3643 standard hard-codes anti-money laundering and know your customer rules directly into the token's logic. If an incoming transaction request does not pass the identity verification module, the token physically cannot be transferred. The contract also natively enforces international banking standards. Basel III liquidity constraints and internal stress tests are encoded directly into the token issuance logic to maintain financial stability metrics. Once the ERC-3643 tokens are minted, the Lex node operator shifts from a setup phase into an active management strategy. The collateral base must be utilized to generate liquidity. The primary method is a tactic called ratio playing. The operator tactically reallocates the assets between different forms of gold exposure within the closed trust system. The objective of ratio playing is to capture internal appreciation in the value of the metals over time. By doing this inside the closed loop of the tokenized trust, the growth occurs independently of fiat interest rates. Any gains generated from the strategy trigger a protocol known as the settlement imperative. The settlement imperative mandates that all profits must be immediately documented on-chain and settled. This eliminates off-books accounting and ensures every increment of appreciation is verified in the permanent ledger. ERC-3643 tokenization enforces absolute fiduciary discipline at the code level, restricting the movement of the asset to actions that are strictly compliant and documented. The legal verification and the ERC-3643 tokenization are preparations for a single objective: leveraging the digital collateral to instantly discharge a real-world fiat liability, such as a mortgage or a credit line. The ultimate execution of this settlement operates under a strict protocol referred to as seasoning with Caesar. Seasoning with Caesar views fiat currency as a toxic inflationary liability. The rule dictates that the trust must only touch fiat infrastructure for the exact momentary fraction of time required to settle an external debt. To achieve this speed, the system deploys a mechanic known as the gold bullet. At the core of the gold bullet is a specialized financial instrument called an atomic flash loan. This diagram features a horizontal timeline scrubber representing a single 12-second blockchain block. The system utilizes a 235% liquidity model, allowing the tokenized gold to draw heavily leveraged fiat value specifically for the duration of this timeline. Within that 12-second window, the smart contract executes a strict chronological sequence. It borrows the exact fiat amount required, transmits the fiat to pay the bank debt, and instantly repays the borrowed fiat using the internal value of the tokenized goldbacks. This sequence is protected by an atomic reversion shield. If any single condition, the borrowing, the bank payment, or the internal repayment, fails to execute within those 12 seconds, the entire transaction rolls back. It reverts as if it never happened, preventing the trust from holding an unbalanced debt. When the sequence clears successfully, the protocol generates two permanent outputs. First, it mints a soul-bound token, a non-transferable digital receipt verifying the payment. Second, it exports an audit pack containing the JSON hashes of the transaction. The audit pack provides the final link back to the traditional legal system. It serves as prima facie evidence for regulators and courts that the specific bank debt was satisfied according to the original security agreement. By utilizing the Lex node operator to translate physical gold into a legally perfected, machine-readable format, the individual bypasses the friction of traditional banking. They operate a mathematically enforced economy entirely on their own terms.